If you Google the list of the largest private equity firms globally, you can easily find that those companies have billions of dollars under management. Carlyle Group, Blackstone, Apollo, KKR, you name it. Have you ever wondered how these companies operate, where they raise such huge amounts of money, where and how they invest, earn money, and similar? In this video, we are going to explain those and other how-to questions behind the private equity industry. First of all, what is private equity? Private equity refers to specific investment vehicles that acquire, manage, and resell mostly private companies, meaning those that are not listed on public stock exchanges. These funds are launched and managed by specific entities called private equity firms, with a purpose to pool together capital from numerous institutional investors and high-net-worth individuals in order to flip different targeted companies, meaning to buy, restructure, and eventually sell them, typically at a profit. Basically, a private equity fund is usually structured as a limited partnership that is owned jointly by a private equity firm, also known as a general partner, and other investors, such as pension funds, insurance companies, high-net-worth individuals, endowments, foundations, sovereign wealth funds, and similar. Usually, a private equity firm's stake in a fund gravitates towards just a few percent, just enough to show commitment and get the managerial rights. Next, this pooled-together capital is used later on to finance individual private equity investments, meaning it's channeled through a set of newly established companies, or NewCo, that receives equity investments from a private equity fund in order to acquire targeted individual companies. And here is a catch. That's just a portion of money needed and used for the acquisition. Each NewCo also obtains additional debt financing from lenders, for example banks, where usually 50 to 80% of total sources comes from debt. That's why we speak about leveraged buyouts a lot when mentioning private equity. For example, if a fund acquires company X for 100 million euros, where its own investment is 40 million euros, and the remaining 60 million euros are coming from the banks, the fund is trying to utilize positive leverage effects. For example, after improving the operations at target company, it sells the company in 5 to 7 years time horizon for, say, 200 million euros, and repay the debts to banks. For example, 60 million as a principal and additional 20 million for the interest. That means the fund will walk away with 120 million euros, where 80 million is a net profit. That's IRR of 17 to 25%, depending on the exit year, plus possible dividends during the holding period, compared to only 10 to 15%, plus possible dividends, if the acquisition was financed solely with its own equity investments. Again, depending on the exit date, meaning after 5 or 7 years. That's why a targeted company is usually some underperforming matured, yet cash-rich company in order to be able to service the debts on its own during the period between the entry and exit momentum. And, most likely, it has strong assets that might be used as collateral in order to be able to raise such a huge debt level. We've already explained the core target characteristics and earning strategies in our past few videos, so check it out if you've missed this. Here, it's important to highlight that a private equity fund works hard to fix, elevate, or improve the operations of the target, often by implementing cost-cutting measures, enhancing management teams, or restructuring the business. The goal is to increase the company's profitability and market value. It's not a passive investor. Actually, the general manager has his hands on, and he is responsible for making investment decisions and restructuring targeted companies, while other investors are passive. They bring the money on the table. On top of that, the private equity industry has many other interesting characteristics. For example, private equity funds are so-called close-end funds. That means the investors are locked for the next 10 to 12 years. Basically, the fund is raising money from various investors. During the initial few years, that money is used to acquire many companies simultaneously and create an investment portfolio. Each company is held for the next 3 to 5, maybe even 7 years, based on the overall market circumstances, time needed to improve the business, and find a proper buyer. The last 3 to 5 years are used for the harvesting, meaning for selling remaining individual companies from the portfolio, and to pay out the investors and close the fund. Exit is usually based on selling individual companies to strategic partners, other funds, or via IPO, meaning making the exit by listing the company at some stock exchange. Compensation is another interesting topic. Private equity firms, who manage multiple private equity funds simultaneously, are compensated in two main ways. Management fees. Private equity firms charge an annual management fee, typically around 2% of the committed capital, to cover the costs of managing the fund. This fee is paid by the limited partners regardless of the fund's performance. Carried interest. Carried interest is the primary source of income for private equity firms and is usually around 20% of the profits generated by the fund. This performance-based fee is only earned if the fund achieves a certain level of returns, known as the hurdle rate. Finally, we can say that private equity has a significant impact on the companies it invests in and the broader economy. On the positive side, private equity firms often bring operational expertise, capital, and strategic direction that can help companies grow and become more competitive. However, the use of leverage and aggressive cost-cutting measures can also lead to layoffs, increased debt, and, in some cases, bankruptcy. For sure, private equity is a complex but powerful investment vehicle that has reshaped industries and generated substantial wealth for investors.